The broadcast is now starting. All attendees are in listen-only mode.
Let's do it.
All right. So since most everybody has already attended an ASTPS, for those that haven't, just understand that I wrote a piece of software that analyzes transcripts. Hence, that's somewhat why I'm a subject matter expert. So for those of you that know me, you know I basically live, breathe, and everything else transcripts for about the past decade. So I will get to some slides that are basically slides of the exact IRM. In some cases, I've summarized them. So for the purposes of the presentation, I'm going to go over the summary slide, just point out that the IRM is included in the presentation, but I'm not going to read all the IRM slides, just the highlights. That's going to keep us moving along a little bit as well. I wrote this presentation to where the PDF of the slides you have in the handout have enough examples and definitions that not only can you look at your own cases by reviewing this, but I have examples of just about every step of this logic. So if you're trying to figure out an A SED, an R SED, or a C SED, this presentation as a resource should be good for you. So there's a lot more material that's in the written format than we're actually going to review on the actual presentation itself for time. This presentation will cover the IRS statute of limitations. The three statutes are assessment, refund, and collection. The statutes are very clearly defined, but certain events can extend them. These events are referred to as tolling events and can complicate the statute calculations. The presentation will cover calculating statutes and contesting them with the IRS. The focus of this presentation is on the individual account, but some business rules will be covered as well. And just so you know, this is being recorded, so it'll be available probably not immediately after. We generally step through the presentation, make sure it recorded all right, but it should be posted, I believe, at ASTPS and also at Tax Help Software sometime in the next week or so. So if there's anything you want to review, you're more than welcome to. Okay. Disclaimer. Okay. So I've never put a disclaimer like this on any of my presentations before, but in this case, I believe it is warranted. There are conflicting statements between the IRM and revenue rulings and some unclear verbiage in the code as well. My advice is to always make a claim for refund or file a return before the due date or timely file date when possible. I'll take that one step further. If a customer comes to you today and says, I may possibly have an amended return that may result in a refund, or you determine that, the best suggestion is file that amendment as soon as possible. You may want to look if it qualifies, if it's going to be a lot of work on your end, but if it's something you can get done rather quickly, don't spend a day trying to calculate when exactly the RSET is. It may just be better to go ahead and apply for the RSET. For example, if you're applying for a first-time penalty abatement where they don't have prior tax debt, that may be something that's quicker just to make the attempt instead of trying to do the calculations. Please do not interpret this presentation or presented examples as an excuse to skirt the rules, as you may cost your client significant money. Please don't call me up next year and say, hey, I went with this specific position and I didn't win it. What I'm doing is providing you enough material to take a position. It doesn't mean the IRS will take the position, even if it is a correct position. So this is not clear cut. There's a lot of gray areas when dealing with the IRS. All right, but thanks to Murphy's Law, I've personally observed on multiple occasions where a taxpayer comes in that gray area time frame between the due date and the extended due date from a look-back event. In those cases, if you choose to appeal a denial, this presentation will help you with that position. Handout overview. So I added some of the revenue rulings that I discuss here. They're great to review. I would definitely review each and every one of them because they're very specific examples of what's going on. The biggest one in there we're going to talk about is there's an actual memo from IRS Chief Counsel to the programmers at the IRS for the computer system, where they basically say the system is incapable of calculating the RSED correctly. And we'll talk about that with some examples. Fortunately, they err on the client's behalf, not on the IRS's behalf. So they're actually extending the RSED farther than they should be, so it's in your client's benefit, but we'll review that and show you. Those of you with NAEA that are on the Facebook page, there was probably a 100 response conversation the other day about this. And there was a lot of opinions in what to do. There's a lot of right answers. I'm kind of trying to teach how the IRS actually does it. Reason we're doing this webinar again, I think we did it 2 years ago, is this is going to be the first part of a two-part series. So the next webinar will cover how to identify and contest incorrectly reported IRS tolling events. This one touches on it. This is going to be at least a 1 or 2 hour course that'll follow up with that. I'm going to get LG hopefully to help me be the co-presenter. We've talked about it in the past. I'm going to do the presentation, but I want to bring him in for some of the offer and compromise, and that's his specialty. So I'm going to bring him in to discuss some of that. The tentative date for that presentation is June 13th, 2019, and we'll start getting some information out on that as well. One thing that we've noticed, we'll talk about in here, but the IRS has started to extend pending installment agreements on CSED dates multiple years. And we wanted to be able to put something out there now that we've seen enough of these cases. The IRS is definitely kind of using it as a workaround, a trick, a best practice to extend CSEDs when they shouldn't be. And that's going to be the primary topic of dealing with those pending installment agreements that are left open. All right, so what is statute of limitations? Here's the IRM. It's the exact or the precise definition, but I'm going to go to the layman's definition. The statutes are deadlines defined by law that affect the taxpayer's debits and credits on their IRS accounts, known as modules or periods. First-time abatement is an administrative function. It's not by law. That's why there's kind of some leeway to it. When you get into statutory definitions for certain things, you're going to get less leeway from the IRS, but you're definitely going to have defined appeal processes as well. Okay. So I'm going to start it off with a trick question because a lot of you are probably like, hey, I'm an expert on this. I'm just doing this as a refresher, but this seems to get a lot of people. I was at a bankruptcy seminar last year, NACBA, and bankruptcy attorneys depend a lot on the due date of the return. Well, last year we had this scenario here. From IRS Gov, and this is the IRS definition of what happened last year. In 2018, April 15th falls on a Sunday, and this would usually move the filing deadline to the following Monday, April 16th. However, Emancipation Day, a legal holiday in the District of Columbia, will be observed on that Monday, which pushes the nation's filing deadline to Tuesday, April 17th, 2018. Under the tax law, legal holidays in the District of Columbia affect the filing deadline across the nation. Okay. On Tuesday, April 17, 2018, the IRS computers crashed and the IRS extended the filing deadline to Wednesday, April 18th. And this was in this IR, which is kind of like a press release. Okay. So, presentation note. The author has not found any authority in the IRM or IRC that gives the IRS the ability to extend the filing deadline due to a computer glitch. This scenario does not seem to be addressed under the Saturday, Sunday legal holiday rule either, but that's kind of the most on-point IRM in that it extends that deadline. So if everybody would subconsciously, what do you believe the due date was? Was it April 15th? Was it April 16th? Was it April 17th? Or was it April 18th? And the reason this is important is a lot of these statute dates are based on exact definitions of some of these dates. Okay. So the due date definition, okay, by the U.S. code, and this one I'm going to read, okay. What we're going to do is skip down to where it says returns made on the basis of the calendar year shall be filed on or before the 15th day of April following the close of the calendar year, and returns made on the basis of the fiscal year shall be filed on or before the 15th day of the fourth month following the close of the fiscal year, except otherwise provided. This is not the definition for business returns. You got to go to this IRM, this code section. There's different listings for those, but strictly for individual returns for this definition right here. All right, so the IRM, statute of limitations chart for tax returns, defines the due date to 3.5 months after the end of the taxable year, calendar year, April 15th. Okay, so that is the definition of the due date. Okay, so when the IRS extends the deadline, the filing deadline, they're not extending the due date. So the correct answer is the due date in 2018 was April 15th, just like every other tax season before it. Okay? Go over these points to kind of explain why. The due date is the statutory date the return is due. The filing deadline, also known as the timely file date, is the final date a return can be filed and still be considered timely. That's why if you file after April 15th, but before the filing deadline, the transcript will still say April 15th, because a timely filed return is considered filed on the due date of the return, not the timely file date. Okay, that is a huge point of debate. That definition there has probably caused people to lose millions of dollars in refunds based on the RSET. But in some cases, there's positions you can take that'll extend that. Okay, The IRS can extend the date which the return is considered timely, but it cannot extend the due date. Okay, there will be additional information in this presentation as well as specific examples. So I don't want to dwell on this, that just kind of proving the point that nothing is clear cut at the IRS. There are so many definitions and positions that you can take. This one line has really messed up a lot of people with CSED. Every time I go to an NAEA conference or ASTPS or NATP, this inevitably comes up, and it's they only have a substitute return filed. There is no CSED. That's not true, but this is where the misnomer comes from. The posting of the SFR, substitute for return, does not set the ASED or RSED or collection statute expiration date. That's true, okay? The SFR will be discussed in each assessment section. The CSED is based on the assessments, okay? The ASED and RSED rely on when and if the original return file date is. The CSED strictly relies on the assessment. So if you get an SFR and the IRS assesses you, that assessment date is what starts the 10-year clock. And we'll talk obviously about that more extensively as we move forward here. All right, so when is a return considered filed? Okay, here's the IRM statement. And in this case, in general, a document is filed on the date that it is received at the place designated for filing by the service. If you look at this IRS IRM section, the last time I gave this webinar was 2 years ago. They have since updated almost all of the IRM references October 1st, 2018. And I'm going to kind of go over some of those changes here for you so you can see what's changed. In essence, not a lot's changed, but they've just put better definitions into place. Or I think they're a little better. So in most cases, the easiest way to determine the return file date, okay, if no SFR was filed, is on the account transcript, presence of a 150 tax return file transaction, and then look at the return due date or return receive date, whichever is later. And this is what it looks like on the transcript, okay? Note, the processing date is often confused with the filing date. The processing date has to do with the movement of money, such as the refund or applying payments to the Department of Treasury. The processing date you see here of April 1st, 2013, and yes, the processing date can be earlier, but a lot of times it's later, okay? The date on this 150 tax return filed would be April 1st, 2013. The processing date generally matches the tax return file date that's listed in the transaction code. But to reiterate, it's this line, the return due date or return receipt date, whichever is later, is what the IRS uses in their system. Okay. Exception to IRS system statutes. All right, so this is one of the changes that they put out. Okay. In October 2018, the IRS updated IRM section 25.6.1.6.14, criteria for establishing statute of limitation period. This change is significant in that it allows the IRS to override the return receive date in their system, which is the one I showed you on the transcript. The following 2 points highlight the changes. The IRS now applies what's called the Beer test, and it's a case law, I think deriving out of bankruptcy, but I'm not 100% sure. I know bankruptcy uses it, but it's a famous case that defines a return. And that's to determine if the return constitutes a tax return. And you might be thinking to yourself, well, of course it defines itself as a tax return, but there's a couple of exceptions. Number 2, if there is a tax return determined to be an ID theft return, a return not filed by the individual or business whose tenant is, then that date could be wrong. So even if the transcript says it, there could have been an ID theft on the transcript or on the tax account, and in which case the system date would have to be overridden with the real date. So I want to caution you on that. Another thing that the Beard test talks about, we'll talk about in a minute, you got to sign under perjury or it's not a return. Okay. And again, the author believes the IRS was using this criteria as a point of policy prior to the IRM change. The update better defines what is a return by citing the Beard test from case law and how the IRS addresses ID theft cases. They probably got tired of disallowing what was on the transcript and having to explain why, so they added it to the IRM to kind of better bolster their case on their position. Okay, here's the actual IRM that talks about it. A little bit about the criteria for determining whether a return is valid are as follows. There must be sufficient data to calculate the tax liability shown on the return. Okay, the document must claim to be a return, a name, an address, and a TIN at minimum. an honest and reasonable attempt is made to satisfy requirements of the tax law. It must be executed under penalties of perjury. The C. Beard part right here basically defines all these steps. Okay. The biggest part of this is the taxpayer must sign the return under penalties of perjury. If a return is received unsigned, the statute of limitation on assessment does not start until a signed return is received. Okay. Now, there's always the debate over on an SFR, if the client signs the letter that the IRS sends them for the SFR and basically accepts the substitute for return, in some court cases, a return signed SFR letter back to the IRS is considered to be an original return in some bankruptcy cases. I'm not going to go into the details of that, but there was some case law at one time, as long as it hasn't been changed recently, where there were very specific examples in specific districts where that met the criteria. That could also be argued here. It's beyond the level or the depth that this class is going into, but just be advised of that. Also be advised that 99.9% of SFRs, the client didn't sign and send it back in. So if you're holding out hope that your client did sign it in hopes of starting an ASED or something along those lines, I wouldn't hold your breath. Your client would more likely know if they signed that and sent it back in. The identity theft one. The IRS breaks identity theft into two parts. One is...
Hey, Roger.
Yes.
I'm going to do the first polling question.
Okay.
All right, so we'll give you guys about a minute to answer that.
And I think if I remember, Mitch, it doesn't really matter what you answer. You just have to answer, correct?
Oh, yeah. Oh, for sure. Yeah, I ask, ridiculous questions sometimes.
Somebody asked me last time, what if I get a question wrong? And I'm like, I don't think that you can.
In the one I did a couple weeks ago, I put, the question was, did you know that ASCPS is going to be have their 3,000th boot camp attendee? And the answers were all, oh wow, that's great. Oh wow, that's awesome. Oh wow, that's amazing.
Not enough enthusiasm. You're wrong.
All right, we'll give you guys about 10 more seconds. You know what's funny about polling questions? We could leave it open for 5 minutes, but as soon as I close it, somebody always types in that they just missed it.
I'm sure there's people out there doing work today, just kind of half listening.
All right, I'm going to close it now. All right, there you go.
All right, so the first identity theft is somebody working under your taxpayer identification number. We see this a lot of times where undocumented workers, in order to work, just buy a social security number off the street and work under it. Okay, that one doesn't affect the filing date or the beer test or any of that. It's the second one that affects that, and that's when somebody files a tax return under a TIN that is not theirs. In this case, that's the one that the IRS can go back and say, yes, the receipt date was shown as this. However, that wasn't your client. It wasn't a valid return. And that's sometimes when you got to go in and reconstruct when the actual return was received. And we'll get into some of those ways here coming up in the presentation. I will say we get into the nitty gritty of return filing dates and some of that early in the presentation, because all that flows down into the ASED, RSED, and CSED later on. So it does get more entertaining here, I hope shortly, but this is the real nitty gritty IRM stuff that defines everything else going forward. And again, you have access to this PowerPoint presentation to use as a reference point if you ever get one of these cases. So if you ever call me for a reference, if you're a user of the software, we do case consultations, but just try to do it on your own first. Don't just call me up because you got one of these cases and get me to do the work. Try to figure it on your own, and then I'll help you review the material, or Laura will. Okay. The easiest way to determine the return file date for an SFR. If you see the transaction 150 substitute tax return prepared by the IRS, the best way to find out if an original return was filed and the date of filing is to call the IRS. Some tips to determine if an original was filed after an SFR is if the number of exemptions is greater than 1. If the filing status is not single or married, filing separately. If you see the transaction on the account transcript prior tax abated, these are all indicators that the tax return was filed. I'm pretty good. About 95% of the time, I can figure out the date the return was received, but I would still recommend calling the IRS to validate it because they don't always get it right. And unfortunately, lately, just calling the IRS If the answer doesn't sound correct, understand that there's people at the IRS that don't know how to read their own computer screens. Okay, so sometimes they'll give you a wrong CSED or a CSED for the earliest CSED and not the latest CSED. Just if you don't get that fuzzy feeling from the person you're talking to, then I would definitely recommend calling back and getting that information from somebody else. If you really need to go down that path of having to know, then FOIA the data you need and get it in. The new online electronic FOIA apparently is pretty quick and works very well. The early filed return rule, okay? When a document is treated as filed under the IRC, okay? An early filed tax return, okay, subsection A here, a tax return that is filed before the due date, determined without regard to any extension of time for filing, is considered filed on the due date. So if I file a return on February 10th for the current tax year, the return receive date would be considered April 15th. Okay, again, that due date. Now let's say I had an extension filed, okay? And this is important as we go through these next few slides, so I'll try to explain this and break it down as to the whys. An extended due date. An extended due date is not treated like the regular due date, okay? You still have your primary due date. An extension is an extension of time to file. When the IRS refers to it as an extended due date, it really isn't extending the due date. It's giving you an extension of time to file. Okay, so even they refer to some of these extensions as due dates, but they're really not by other definitions. So the filing is not considered early when a taxpayer does not use the full extension period. So what this is saying is if a return is filed between April 15th and October 15th, the return file date is the date the return was filed. So if I file a return on June 1st and I have a valid extension, the return file date is going to be June 1st, not October 15th. Okay? And a timely return received before the end of the extension period, including postponement for disaster relief and combat zone, is considered filed on the receive date, not on the extended due date. Okay? And then important at the bottom, for purposes of the RSED, the refund statute date, the extension date is considered the original return filing date if the return was filed on or before the date. So even though the IRS defines early filed return rule, for purposes of the RSED, they're giving you to October 15th if you filed an extension. So for those of you that are blindly filing extensions, although you could inevitably be causing your client some issues with future bankruptcies, you're also helping them by extending their RSED by 6 extra months. And I have seen where that makes a difference. Okay. We're going to go into depth on that a little bit later. So the early filed return rule examples. If the due date is April 15th and the taxpayer files on March 1st, 2015, the return file date is considered April 15th, 2015. Example 2. If the taxpayer files an extension until October 15th, 2015, and the taxpayer files on March 1st, 2015, the return file date is considered April 15th. Again, before the original due date, it's considered the due date. Example 3. If the taxpayer files an extension until October 15th, 2015, and taxpayer files on June 1st, 2015, the return file date is considered June 1st, 2015. Just reiterating the previous example. Okay. Timely mailing rule. All right, so this one's kind of gone away with e-filing, but I do know that there still are people that will file, they've got their little tricks and things that they do. Sometimes people will force a rejection on April 15th or October 15th because you have the 3 extra days to get it filed or the 2 extra days. So this is probably going away a little bit in lieu of that, but people still mail returns in, okay? When is a document treated as filed under IRC? So the timely mailing rule. In general, an original tax return or claim for refund that is received after a due date, including an extended due date, but that is postmarked or that is marked by a designated private delivery service, FedEx, UPS, those kind of things, on or before the due date is deemed to be filed on the date of the postmark or designated PDS mark. A document filed with an authorized electronic return transmitter is deemed to be filed on the date of the electronic postmark given by the electronic return transmitter, and that's a treasury reg, okay? I don't know about you, but I get a lot of letters in the mail now that are no longer stamped. So it goes into this whole crazy thing about how they determine. So if you're going to mail something, definitely get some kind of documentation from the Postal Service or the PDS, the Private Delivery Service, about when it was mailed, okay, to support your position later. All right, so the biggest one that affects the filing deadline is the Saturday, Sunday legal holiday rule. So when a document is treated as filed under the IRC, so covers Saturday, Sunday legal holiday. We always refer to it as SSLH rule. In general, when the last day for filing falls on a Saturday, Sunday, or legal holiday, and the taxpayer actually filed by the next succeeding day, which is not a Saturday, Sunday, or legal holiday, the tax return or claim is considered to be timely filed on the day received. For example, when the April 15th falls on a Sunday, Section 7503 extends the due date of income tax returns to Tuesday, April 17th, because Monday, April 16th is a legal holiday. It's the Emancipation Day that we talked about earlier in Washington, D.C. Section 7503 does not deem a different filing date when a filing is actually received by the next succeeding day. Okay? For example, a Form 1040 received on Tuesday, April 17th is considered filed on Tuesday, April 17th. Now remember, the transcript is going to show April 15th. So this little fact here is important later on. I've actually had my dad file 3 years after the fact on a refund or something where the RSED was out and actually contested it because he had the electronic receipt that showed the return was filed on April 17th. And he was actually able to file 3 years in the future on April 17th an amended return for a claim for refund. Okay, so you don't always go with what the transcript says, but again, go back to my disclaimer early on. Don't dilly around. This would be for somebody that walks in on April 16th and says, hey, I need to do 4 years of returns. That's why you may want to do the third and fourth year rather quickly to see if you can get it in time. Okay, and it could be a significant dollar amount. So the legal holidays affecting statute dates. All right, the term legal holiday, the IRS has to define everything, means a legal holiday in the District of Columbia, and in the case of any return statement or other document required to be filed. So think like CDP filings and believe tax court petitions, if I'm not mistaken, not a lawyer, don't take it as legal advice, that anything you're sending to the IRS that's due on a Saturday or Sunday, this I believe applies. Okay. And that to finish up with this, required to be filed or any act required under authority of law to be performed at any office of the U.S. or agency located outside the District of Columbia. The term legal holiday also means statewide legal holidays. So everybody out there in Boston and the Northeast, you guys have your Patriot Day. I believe it's Patriot Day, the day they run the marathon on. So I'm not going to go into the depths and details of that. I'm sure you're more familiar with it than I am. But state holidays can also affect this, but you in the local states probably know more about that than I do. So beyond the scope of the presentation. Here's the list of the legal holidays. Not going to spend a lot of time on it. These are just the most common. And again, if you've seen in all this listing, there's nothing about a computer glitch. I expected the IRS to add something about the computer glitch or the system error issue in the SSLH rule, because that seems to be the one that would apply the most to this. If anybody does have a site other than a press release from the IRS that says why they were able to extend the filing deadline, like an IRM quote or a IRC, something, please send it to me and I'll add it on the next presentation. SSLH rule examples. If the filing deadline is April 18th, 2017, and the taxpayer files on April 14th, 2017, the return file date is considered April 15th, okay? Like we said before. However, that other revenue ruling says it's actually this is the next example. If the filing deadline is April 18th and the taxpayer files on April 18th, the return file date is considered April 15th. This is what will show on the transcript. However, for purposes of the ASED and RSED, the return file date is April 18th, 2017. I believe everything that supports this position is in the handouts that I handed you or gave out with the presentation. So note, unless you filed a return or the taxpayer knows they filed during the SSLH rule, you will not know. Always treat the return file date on the transcript and then research it only if it matters. So if that person comes to you on April 16th or 17th, research it. You might be able to get them a refund, okay, if you act quickly. Assessment statute expiration date. Going back to that last point, even if you got in a return that was pretty close, you can always amend that return, and if more money was coming back, you can always correct it. Just basically go in and file with the return that you can best determine in order to keep that money into play, as long as you're not putting in a fraudulent return. Don't confuse my words here. But if I was putting together a return with all the information they had on that day, I would be confident if I felt it was reasonably accurate, with the understanding if new data came up in the next week or two that we'd go ahead and amend it, so they weren't getting any money. Because remember, the IRS will get the money back from you over 10 years. They only give you 3. Okay, I never understood that. We'll talk about the IRS's 10-year rule in a minute. So the assessment statute expiration date. The ACED defines how long the IRS has to assess tax for a specific modular period. This gets real important when you start looking at 941 cases and other things out there. IRS a lot of time gets busy and things get shelved, and ACED expires a lot of time, leaving you out, to where if you can contest these, you may just be able to get rid of the assessment completely. Why do collections work when you can basically just wipe out the debt? Okay. In most cases, the ACED is calculated as 3 years after the original return receipt date, not postmark date unless it arrives after the due date and was postmarked on or before the due date, goes into the mailing rule, or return file date, whichever is later. Okay. So if I don't file a tax return for 10 years after the due date, the original return, my ACED is from that year 10 years in the future of the due date plus 3 years. So the IRS now can basically assess 13 years in the future. Okay. The ACED does not start until an original return is received. Okay. An SFR is not considered an original return. Okay. It's debatable if the client signs it, returns it, but you're going to have to take a severely hard position on that and may need a tax attorney or a U.S. tax court person, or maybe assist the client going pro se. But I think that one's going to be a little bit outside of somebody doing a pro se argument, just based on the amount of legal representation in there. Okay. Common ACED tolling events. Okay. Filing an amended return within 60 days of ACED. Okay, so if you're coming up on the ACED, you're going to drop an amended return, they drop a little extension on there. So you can also get a voluntary extension of the ACED. That's where the examiner kind of calls you up and goes, hey, we're just going to drop and do a rush assessment here. We'll extend it if you're willing to go ahead, and we'll give you rights of appeals and talk through it. If you tell us to pound sand, I'm just going to assess everything and we'll move on. Okay. The joint return after filing married filing separately can extend it. Okay. There's a whole set of rules about when you go from married filing separately to married filing joint. I basically refer to it as jumping on the train. Just remember, you can jump back on the married filing joint train. You just can't jump off of the married filing joint train once the due date arrives. Okay. Fraudulent return. Fraud is forever. They'll assess you 200 years from now. They will go after your estate if they're still in the state. Underreporting of a tax extends it. And so the last one here, we've kind of found some interesting stuff out. So statutory notice of deficiencies, the 90-day letters, a lot of times don't show up on the transcript. And this just came across my desk last night talking with my dad. We now think when you see a 560, I think it's a 560 transaction code that talks about the ACED, it basically says the IRS can collect until. When you see that IRS can collect until 560 code, it could be a manual extension by the IRS, but when the IRS files a statutory notice of deficiency, it's an automatic extension of the ACED, okay? And I believe it's 150 days, but we'll get into it when we get to that slide, okay? So we're going to add that into the THS software to where we pop the 560 as a probable notice of deficiency, because it could also be a voluntary extension as well. There's no way to tell. There are uncommon tolling events. I'm not going to go into them, but here they are if you ever want to go back. Think of it as presidentially declared disaster areas and combat zones. Now, with that being said, the IRS in certain cases in these, presidentially declared disaster area, everybody in Houston last year, I believe, got an extension. So if 3 years from last year, you wanted to file an RSED, but they didn't file an extension, you would take the position that, well, they lived in Houston, they had an automatic one applied, and that buys you an extra 6 months. Okay. Just be advised, there's always some kind of little gray area or trick, but It doesn't say it has to be a filed for extension. It can be one of these ones that's automatic. Okay. Amended return summary. Okay. If an amended
Yeah,
return,
Roger.
yes.
I'm going to do the second pull-in question.
Okay,
now.
good stuff. I'm doing here.
All right. So again, you guys have a minute to answer this question.
Yep, and I was going to say we're going to just let everybody know we're going to be getting into CSEDs last because it's the biggest section, and we'll kind of go through that. The next presentation I do with LG, we're actually going to walk folks through actual CSED calculations, kind of real world cases. I'm going to try to get some transcripts that have some of these falsely closed pending installment agreements to give you an idea what's out there. But I've had several people literally charge in the thousands of dollars for something that they had less than 3 man hours in to get resolved out. So you were saying, Mitch? I'm sorry.
No, that was much more interesting than what I was going to say. I was going to say we're taking a break at 2 o'clock.
Yep, and 60
No.
minutes.
Cool. Yeah, no, I think that's going to be a great presentation. So, all right, give you guys about 3 more seconds to answer, and then we are moving on.
Yep, and just to give everybody a point of reference, we're at 333 of 75 slides. If I'm going a little bit fast, I apologize. It's just a lot of material. But if there's any of these sections you need to review, again, it's all in your handouts. I went into some spreadsheets yesterday and literally listed the facts out and did some calculating so I could understand this because I was teaching it. And there's just a lot of it out there for you to go ahead and take a look at. So, all right, let's move along. The amended return summary. If an amended return with an assessment is received by the IRS within 60 days of the ASED is extended for 60 days after the receive date of the amended return. The IRS defines the receive date as the date received, not the postmark date. No exceptions. So here's one of your exceptions to the postmark date. Okay. But in this case, they're erring on their behalf to basically say, it's extended, but it's really going to help you because it's going to extend less time. Example, if the ASED is 4/15/2017 and an amended return with a new assessment is received on 4/1/2017, then the adjusted ASED would be May 31st, 2017. It would be 4/1/17 plus 60 days. Okay. For those of you that don't know, if you ever need to add days to a date, just go into Excel and create a date in one cell, put the number of days in the next cell and add the two, and it should come up with the new date. You may have to format that Excel by right-clicking on the cell and say, format this as a date. But that's a quick way to do that if you're calculating CSEDs, ASEDs, or RSEDs. All right. So when filing an amended return near an ASED date, determine if you should wait. Again, if you're 2 days away from the ASED expiring, don't go dropping an amended return to rush it in there. You can still file it right after the ASED unless it's a claim for refund. Then you've got a decision to make. Do I risk extending the ASED to make a claim for refund? Well, if you're filing a valid return for a claim for refund, then you shouldn't be worried about an audit. So, and they can always look at the amended return as well when you file it. One more thing back on that slide. If you file an amended return that doesn't have a new assessment, it doesn't extend it. So if you're just filing kind of let's say somebody misreported some income in one section, but it doesn't affect the bottom line of the return, you just wanted to be a stickler for it, that's not going to extend your ASED. Okay. So amended return tolling, here's the IRM. We just did the example, so I'm not going to go through it. It's here for your reference. Okay. Voluntary extension of ASED. All right. So here's the site. Also, if you're looking at the IRMs and I happen to miss one of the dates and not update the new date, I did go through these in the past couple of days and update them. Just fire me off an email and say, hey, IRS IRM actually got updated on 10/18. I don't think there's any material changes in anything in the presentation, but just a note to help me with the next presentation. So a Form 872, consent to extend the ASED, signed by the taxpayer and an IRS representative prior to the expiration of the normal ASED, extends the ASED to the date agreed to by both parties. Okay. And then note, a period extended by waiver does not necessarily extend an assessment date for all situations. The agreement between the service and the taxpayer may restrict adjustments to certain times. If only one thing is being contested, limit the extension to what you're contesting. You don't want them to come back and go, oh, I know we were looking at Schedule C income, but we just found the Schedule B and there's, $1 million of stock transactions. Okay. Make sure that they understand what you're limiting the scope to. Don't give them carte blanche. But again, understand if you fail to report $1 million in stock, you're probably going to run into the 25% under reporter, which extends the ASID by some more years, which we'll talk about in a second. On the transcript, this appears as 560. IRS can assess tax until date. So the voluntary extension shows up as the 560, but also notice of deficiencies are showing up that way as well. I haven't figured out a way to figure out the difference between the two on the transcript, but we'll obviously come up with something. And remember, the scope can be limited, but the good news is an 872 waiver also extends the RSET. So if you did give a voluntary, you can always go back and get your money at a longer time frame. Joint return after married filing separately. Okay. My dad gets a lot of these. I don't know why, but he just does. For ASED purposes, the filing date of the joint return depends on what returns were filed before the election. This is what gets tricky about joint returns. Some people combine the husband and the wife because it's going to result in a bigger refund. But sometimes it can actually extend what's owed. So if your client owes money and you're looking at filing to reduce the liability a little bit, but they're still going to have a tremendous debt, you may be better waiting and letting it expire. My dad had a case, I think somebody filed a joint return that came in and extended the CSED abnormally long for some reason. And if they had just waited, it would have just expired. So they were trying to solve a problem with one thing and ended up costing money on the other end. Okay. So the joint return is deemed filed on the filing date of the last separate return, but not earlier than the due date, where both spouses filed separate returns. So if the husband filed on April 15th, but the wife filed late on June 1st, their file date on the joint is now June 1st. Okay. The joint return is deemed filed on the filing date of the separate return, but not earlier than the due date where only one spouse filed a separate return and the other spouse had gross income of less than the exemption amount for the year. Okay. So the joint return is deemed filed on the actual filing date of the joint return where only one spouse filed a separate return and the other spouse had gross income of the exemption amount or more for the year. So the other spouse didn't have a requirement, so it's just the filing date of the new return. Okay. The service has 3 years from the deemed filing date of the joint return to make an assessment. In no event, however, will the service have less than 1 year from the actual filing date of the joint return to make an assessment. Okay. It's kind of one of those, you can do it this way, but we're also going to give ourselves a little leeway in. Okay. Fraud is forever. Okay. Just understand there is no period of limitation on assessment for false or fraudulent return with intent to evade tax. And the biggest thing in the presentation note here is the fraud does not need to be committed by the taxpayer. If your tax professional is the one that committed the fraud without your knowledge, technically that return has a never-ending ASED, even if the taxpayer was oblivious to the fact. So it's an important point to note there. Let's see here. I thought there was one more thing on here. Oh, the other thing is an amended non-fraudulent return submitted after a fraudulent return does not begin the period of limitations. So once the bad original return was filed and considered fraud, there's trouble. Now, fraud is a tough one at the IRS. It is a quote-unquote subjective definition. The IRS doesn't say if the income is under a certain dollar amount or if they did this specifically. It's out there. So U.S. tax court professionals, tax attorneys, criminal attorneys, they go after the fraud definition because just because somebody was convicted of some kind of tax case, I know there's cases out there where they were actually able to say, even though they're convicted, we don't deem it to be fraud, and this is why. So again, you get into all the nuances of this, and sometimes you need to go to somebody with higher credentials than you have. So as a consultation. Underreporting of tax. This is the 25% omission. This one is common. Okay. I've had people call me up recently and say, hey, you said the ASED on the return is 3 years from the due date. It's a year after that, and the IRS still came back and assessed. And I asked, well, what did they assess on? Oh, well, they forgot to report, $100,000 in stock sales that resulted in an $80,000 capital gain. Oh, was it more than the 25% of the gross income reported? Yep. I said, well, that's this exception. Okay. The software only shows the 3 years for those that indicate the software. Just be aware that the 25% omission is always out there, but we have no way of knowing if there's 25% because we can only go based on what's filed. So, and what this says is the tax may be assessed within 6 years after the original return was filed if the taxpayer omits more than 25% of the gross income reported on original Form 1040 and then the rest of these forms, or more than 5,000 in income attributable to a foreign financial asset required to be reported on Form 8938. I had somebody call me on a case recently. They called up and said the IRS extended the ACED and it was only on a $6,000 difference. And I don't understand why, because the guy made like $1 million a year. And the problem was he had a foreign account that was like $6,000 and it fell under this criteria and they were able to go back and assess on it. So just be aware there's always multiples, okay? Statutory notice of deficiency, the 90-day letter summary. The statutory notice of deficiency tolls the ACED for a total of 150 days, 90 days from the time the letter was mailed, not received, plus an additional 60 days. The statutory notice of deficiency does not always show up on the transcript. Sometimes the ACED shows up as a TC 560 IRS can assess tax until date. I've seen 3 confirmed cases of this where I know what the statute or the notice of deficiency date is and the transcript was in hand. We're still working out the logic on this one, but it looks like it's going to end up testing out to at least a probability that a 560 indicates a notice of deficiency. But also remember, it could be a voluntary extension. But in order for that voluntary extension to exist, your client would have had to have just signed it recently. So hopefully it's fresh on their mind. This is the IRM supporting the summary on the previous page. We don't need to review it. It's there for your reference later on. So strategy for delinquent returns, okay? I think it was Don Rosenberg and my dad got into it over this. It was like 2 bears fighting in the woods. You know, they both had their positions and everything else, but the strategy for delinquent returns, and not picking on either one of those guys, but it's been a long debated, you know, when you should do something. There's not necessarily a right answer. There's just 2 different positions and strategies on this, okay? If an original return is never filed for a tax module, period, the ACED never starts and the IRS can theoretically go back forever. So, should a delinquent return be filed if it has been several years since it was due? Okay? Yes, always start it, and the 2 positions are yes, always start an ACED to limit future liabilities. No, let sleeping dogs lie. How would I handle it personally? If I had a client that came in that had $2 million of income and all kinds of craziness and all that, my recommendation would probably be let's go ahead and start the ACED. Because if you don't start the ACED with an original return, it could lean towards a criminal case based on the dollar amounts. And because of that fact, I think you start it. Are they going to owe money? Absolutely. However, if he never files, you're going to have a criminal potential hanging over your head for the rest of your life. Okay? If a client comes to me and it's, you know, I haven't filed, it's 8 years ago, it's outside the 6 years that the IRS requires for compliance, what should I do? And understand, and we'll talk about this at the bottom, never tell somebody they don't have to or shouldn't file. You're presenting them the 2 positions. It's the decision is theirs. The other position is let a sleeping dog lie. But I would never say, no, don't file that return. Let the IRS find it. I would present them with both sides and say, which way do you want to go? Do you want to not file it and risk them not finding out about it? Or do you want to file it and be on the safe side? Okay. Remember, it's more revenue for you with the, you know, filing option. So just keep that in mind as well. Don't base it on that, but technically that's what they should do. Remember, the decision should be made by your client and be wary of your obligations under Circular 230 when rendering tax advice. This is one of those tax topics that if you don't write this down or document it and get some kind of receipt or a signature from the client, this is the one that'll get your E&O policy. Because what are they going to do? Oh, my tax preparer told me I don't have to file. Whoop, knock on your door. You know, here it comes. And even if you're golden and solid, you still have to defend yourself. So, and none of us want that. Amendment filed after the ACED with payment. Okay. And then this is the claim for an amount paid after the ACED. And if an amended return is filed after the expiration date of the period, I'm not going to go through it completely. We talked about it already. Okay. Oh, actually, I take it back. We didn't. That was an exception. I apologize. And we're getting ready to break here in 2 minutes. So this is when an amendment is filed after the ASET with a payment. So let's say you file an amended return 6 years after the original return, and you send a payment in with the amendment. They're supposed to give you the money back, and you don't need to do a claim for refund. You just need to call them up, say, hey, I screwed up. Honestly, they should send you the money back. Plus, I believe they have to pay you interest on the time that they held on to the money and send it back. Probably not bad because they're going to pay you more interest than a bank. So, Mitch, let me see what the next slide is. Yep, good stopping point. We're at the start of a new section. It's 1:59 p.m., so this is probably a good time to take the break. We're halfway through the presentation. We're on slide 43 of 75, plus there's the 7 bonus slides, which are going to cover how to get transcripts immediately. So if a client walked in your office right now, this is going to be how you can get electronic transcripts. Software helps, but even if you're somebody that doesn't have software, you just need 1 or 2 transcripts. This is a method you're going to be able to use as well. So, all right, so let's start again. We're on the second of 3 statute dates. We've already covered the ASED, which covers how long the IRS can get money from you. Let me rephrase that. The ASED is how long they have to issue the you owe us, okay? The refund statute is how long you can get money from the IRS. And I always thought it was funny that the IRS had 10 years to get money from you, but you only have 3 years to get your own money back from the IRS. And that goes for anything. There's cases out there where people mistakenly sent 2 checks in and the IRS never sent them back, and 5 years later they realized it. The IRS keeps that money. And it technically, to make it more of a definition, the Treasury, U.S. Treasury keeps that money. So the refund statute expiration date, referred to as the RSED. The RSED defines how long the taxpayer has to file a claim for refund for a specific modular period. Okay. The RSED has 2 components and is the later of the 2 dates. All right. I modified this a little bit later on. We'll talk about it in a minute. There's also something called the 3-year period. The 3-year period should not be confused with the 3-year look back. We'll go into depth on that, so don't get too out of it. The 3-year look back is 3 years since the receipt date of the original return. The 2-year look back is any payment made within the past 2 years. There's exceptions to those rules. This is just to kind of get you started. And again, there's a lot of confusion about the 3-year look back to the wording of the IRM. This will be addressed later in the presentation. Extension of RSED. Okay. The period of limitations for claiming a credit or refund may be extended by agreement only by execution of a consent to extend the period of limitation on assessment. Okay. The period for claiming a credit or refund is extended until 6 months after the expiration of the consent. Okay. They give you a little bonus time in there. So if the IRS asks you to extend the ASED time, they're also extending the RSED, but with a little bonus time. And here's the example. The original return file date is April 15th. The ASED and RSED are the same date, April 15th, 2015. On April 1st, 2015, the IRS and taxpayer agreed to an extension by signing a Form 872 through January 1st, 2016. Okay? The RSED is then July 1st, 2016, because there's 6 months added to January 1st, 2016. And again, you can always go into Excel, put your date, put the number of days in the next cell, plus them, equal them, sum them, whatever you want to call it, and it should come up with the correct date. So the RSED 3-year period, not to be confused with the 3-year rule, and I think this is what gets a lot of people in trouble. So the period for filing a claim for credit or refund has 2 prongs. First, a date by which a claim must be filed with the service, and second, a limitation on the amount that may be claimed that is determined by looking back from the date of the claim to an earlier payment date. Okay, so the IRS kind of combines these, but then defines the 3-year rule separately. Okay, so filing with the service, first prong, a claim for credit or refund described above must be filed by the later of 2 periods. Okay, 3 years from the filing date of the original return or 2 years from the payment of the tax. Okay, this is where it gets a little bit tricky. It's not saying original return, amended return, claim for credit. Sometimes a claim for credit can be other things. If I'm not mistaken, I believe um, injured spouse is a claim for refund, um, because you're asking for something back. So that would be one. I think there's some tax court cases where you can make a claim for refund. Amended return is probably accounts for over 99.9% of claims for refund after the original return was filed. But just be advised that it doesn't only mean an amended return. I throw that out there because there's some pretty sharp people in former IRS where if I don't kind of say some of these things, the questions light up and go, hey, what about this and what about that? So for the most part, it's an amended return, but in some cases, it can be one of these rare examples. So our said 3-year period examples, right? This is straight out of the IRM. A 2005 individual income tax return is received on April 18th, 2006, but postmarked on April 14th, is deemed filed on April 15th, 2006. A claim for refund filed on Monday, April 18th, 2009 is timely. This is straight out of the IRM, okay? So even though the return file date technically is April 15th, because it was received on April 18th, they actually give you a couple extra days, okay? And it's in the IRM. So if you don't get this, this is how you can test it. A 2005 individual income tax return received on Friday, April 14, 2006 is an earlier filed return that is treated as filed on April 15th, the early filed return rule. A claim for refund filed on Thursday, April 16th is not timely filed. Okay? The SSLH rule that applied to some 2005 returns does not apply because the taxpayer's return was not filed on the next succeeding day. Okay? It was actually filed before. So if this client had filed on April 17th, 2006, then it would have applied due to the Saturday, Sunday legal holiday rule. A claim filed on a delinquent original income tax return that is postmarked on the last day of the 3-year period is deemed to be filed on the postmark date. So in this case, they do give you credit for the postmark date when you're sending in your amended return for the 3-year period. The 3-year period only applies, if I understand this correctly, and I could be misinterpreting it, but I know the math works out on all the examples. The 3-year period starts after the original return was filed. Okay, if there's no original return, you're just applying the 3-year rule, which we'll cover in a second, to the original return filing date, and it tells you how many refunds you can get prior to that. This is probably the most confusing part of the presentation. You may have to go back, reread these examples and everything if you really want to understand this. It took me about 2 hours last night, and I wrote the material to get it back in my mind where I understood it completely. So the 3-year period versus the 3-year rule. The 3-year period is the 3 years following the filing of the original return. The 3-year rule applies when an amended return is filed within the 3-year period. If the amended return is filed during the 3-year period, all taxes paid 3 years prior to the claim for refund, 3.5 years prior if an extension was filed. If the amended return is filed after the 3-year period, then the 2-year rule applies. The rules apply to how far back you can look for a refund, right? So if you file the amendment within 3 years of the original return, you can go back to the prior 3 years of payments or 3.5 with an extension. If it's outside of the 3-year period, it's only 2 years. Okay? The rules determine how much can be refunded. The 3-year period determines which rule to apply for an amended return. So in essence, the 3-year period is the determinator on an amended return or another claim for refund other than the original as to which rule to apply. An original delinquent return always uses the 3-year rule. That's why the IRS sends out these letters every year in April and they say, hey, there's $8 billion or $8 gazillion of refunds on these unfiled returns if you file before April 15th. Of course, small print, unless there's an extension was filed, then you have until October 15th. So I hope that kind of starts to clear it up for a little bit. We're going to go through some more examples and definitions. Again, if you come out of this presentation confused, I wrote it and I came out confused until I spent 2 hours last night going through the examples and understanding this, okay? So just be advised. This is advanced material and calculations. Unfortunately, you're not going to use it all this time. You may not use an RSED appeal for the next 3 years, but when you need it, it could literally be worth thousands and thousands of dollars in fees for you. Um, I'll give you a quick question or a quick example. One of our users ended up getting somebody did a calculation on both the RSED and the CSED, and they had made some payments recently, but the CSED expired. It was the open pending installment agreement, and with everything involved, they ended up getting $160,000 written off that the IRS thought they had an additional 5 years to collect, and then got the client of that $160,000 that was dropped off due to the CSED. They had already paid $30,000 of that in the past 2 years. Got their client a $30,000 refund, wiped out their tax debt. They had less than 5 hours of resolution time. Forget OICs and stuff. If you can do that, that's what makes you a successful tax practitioner in the field of resolution. Okay, so the 3-year rule, and I want to say the fees on that were between $8,000 and $10,000, which excessive. Who knows? I saw a little thing on Facebook the other day, and it said, "I've been doing this job for 30 years." which enables me to do your return in 15 minutes. You're not paying me for the minutes, you're paying me for the years. I thought that was appropriate, and I'll kind of share that with you. The RSED 3-year rule. The amount to be credited or refunded is limited to the tax paid, which includes tax penalties and interest, during the 3-year period prior to the filing of the claim, plus the period of any extension of time to file. Okay? Before you go out and say, hey, you know what, I'm going to file extensions on every one of my clients now because I'm helping them. Just understand this. On the back end of things in the bankruptcy arena, I've had to assist people in calculating E&O claims against bank. I don't testify against anybody, but users came back and helped me calculate dates from previous E&O cases that they had worked on. And what happens is if you file an extension for somebody, it also extends the amount of time before they can file bankruptcy. And if their bankruptcy attorney doesn't do a good job and say files the bankruptcy on April 20th, 3 years after the due date, guess what? There may be $100,000, $200,000 of taxes that are no longer dischargeable. And he may have just reached out to the client and said, have you ever filed an extension? Why, no, I haven't. Lo and behold, the tax professional did without their knowledge. That potentially could be an E&O claim. The tax payer does not sign the extension form in most cases, if I understand. It's been a while since I've been doing it. So I know that they can successfully be argued that they didn't file an extension because there's no signature on it. But you got to contest those rules. So just something to keep in mind. There's always an inadverse side effect of anything or any position that you take. I just find that in everything. So the timely mailing rule. Okay, and this is one of the ones I think I attached as a handout. According to IRS revenue ruling, if a claim for refund is postmarked before the 3 years from the original return file date, but is received after, is not considered timely filed for the claim of refund. It is always best to have a claim for refund delivered to the IRS prior to the 3 years from the original file date when possible. My recommendation is to hand deliver the amended to the IRS and get a stamped copy as a receipt as proof to avoid having to appeal a decision. The thing previously, and I could go back in the slides, but it's there, it says it is covered. All right. So now you get into what takes precedence, the revenue ruling, the other thing, the IRM, and now you've got a position if the IRS didn't rule in your favor. Okay. Simpler example for 2017. According to Revenue Ruling 2003-41, if the taxpayer files an extension until October 15, 2017, and files on Sunday, October 15, 2017, they have until Thursday, October 15, 2020 to file a claim for refund on their withholding and advance payments. Okay. If the taxpayer files an extension until October 15, 2017, and files on Monday, October 16, 2017, due to the SSLH rule, they have until Friday, October 16, 2020, to file a claim for refund on their withholding and advance payments. Example 1 cannot file on Friday, October 16, 2020, okay, because they didn't file after that date. The best thing you can do, there is an example in the IRM or this presentation or one of these revenue rulings that will more than likely be on point with your client's exact position. Go through the presentation, further research the IRM if you get one, and walk through the outcome based on the examples that the IRS has. All right, so on top of everything else, the IRS, there's this memo that discusses the 3-year rule. This is actually a quote from this memo. This memo is in your handout, okay? The IRS released a memo on May 24th, 2013 that addresses the 3-year rule as it affects the 3-year rule and extensions. This is a quote from the memo. Refer to your handout. The Section 6511 rules are so complicated that the system, meaning the IRS system, the computer system, cannot currently be programmed to figure out every situation. In reviewing the memo, I believe the IRS is getting the 3-year period and the 3-year rule confused, believing they are the same. They are kind of the same in the IRM, but it goes on to explain the 3-year rule after they define the 3-year period. Due to this, they struggle to properly calculate the RSED. Okay? So here's the example in the IRS memo. But what the IRS in essence says is, the early file return policy is, if I filed June 1st and an extension was filed, technically the RSED should be 3 years from June 1st. Okay? Plus, if there's an extension, 6 months, but the 6 months would stop at June 1st, not October 15th. But they can't program the IRS computer to do it on that. So what the way the IRS calculates RSED is this. They calculate the RSED if an extension is filed as 3 years from the extension date. So it's funny that they have a memo that says we can't do it right, but the good news is they err on the other part. This is kind of the sample that the memo has inside of it, okay? It just kind of talks through everything. And I'm going to go to the next page. So I kind of put it all in a spreadsheet last night. So what this is, and this is probably the best example to understand this logic cue here. And then we'll move on and it'll go a little faster and get a little easier. The due date is 4/15/10. The extension date is October 15/10, and they did file an extension. The return file date is 9/30/11. Okay, so the 3-year period is 9/30/14 per the IRM, not the computer programming. This example is per the IRM, not the programming. The amended return was filed on July 20th, 2014, and the 3-year rule says they can go back to January 20th, 2011. All right, so this kind of shows you everything that's out there. And what it basically says is they made a claim for refund on everything that they paid, but the withholding and the extension payment made on April 15th, 2010 were before January 2011, which is the amended return 3-year rule date. So they didn't get the $1,500 back. So the refund they get is $2,400 because the first $1,500 didn't qualify. So if you're going to review an example for RSED, this is the best one in those 3 sites to look at, or just shelve it. You know, keep the digital copy. If you ever run into the scenario, address back to this. Let me say this. So if you look at the memo, there's a confusion. So they actually say in this memo, the taxpayer sent in $500 with their extension. Okay, I put it in my example as 4/15/10, but later on in their example, they say that the payment. See here where it says sends $500 with an extension. But here later on, and I forget where exactly it says, but it says he can't get the $500 back because it was filed on October 15th. Well, if you send in a payment with the extension, you send in the extension prior to April 15th. So I thought it was funny that even in their example, they kind of screwed up their tax knowledge. So moving along. So now the 2-year rule.
Hey,
So
Roger,
pretty much any, yeah.
I'm going to do the next polling question before you move on.
Okay, good stopping point here. And again, my apologies for how confusing that prior section gets. That's just one of those that it can be a huge dollar amount for you and your clients to look at all that, if that makes sense. I'll plug the software. The good news is the software calculates all 3 dates. Always, especially if it's going to be a big dollar amount, go back and look, because as you see what's on the transcript, which is what our reports are based off of, sometimes you get an extra couple days on there that you would know if they filed, before the extended deadline.
Cool.
And then just let me know when we get going again. We're on slide 55 of 84, so we're making really good time.
I'll give you guys about 10 more seconds.
And again, realistically, I think we'll be going to just shy of 3 o'clock for the statute presentation. And then I've got the 6 or 7 slides for those that want to hang around that'll explain how you get the transcripts day one with a POA or 8821. You don't have to send them to the CAF unit first.
All right, there you go.
All right, so the RSED 2-year rule. We've talked about it pretty extensively. I'm not going to spend too much time on it, but if the claim for credit or refund is not filed within the 3-year period for filing a claim, the amount is limited to the portion of tax paid. The payment of tax could be for tax penalty or interest within the 2 years period immediately preceding the filing of the claim. Presentation note: the 2-year rule comes into play if the amended return was filed after the 3-year period, including 6 months for a valid extension. Okay. 2-year rule examples. For tax year 2000, taxpayer files a tax return and pays $5,500 of income tax on April 15, 2001. On March 1st, 2004, the taxpayer pays $1,500 as a result of an examination adjustment, increasing rental income. The ASED date was not extended and expires on April 15, 2004. They're telling you that because they don't want you to think there might be an extension or a tolling event. On May 1st, 2004, 3 years and 15 days after the original return was timely filed, the taxpayer files a refund claim for $2,000 to dispute the examination of adjustment to decrease rental income below the amount shown on the tax return. The taxpayer may receive only a $1,500 refund. And when they say may receive only, that means they're only going to get. Let me define that for you. It's not optional, maybe, probably. It's statutory. It'll be a $1,500 refund, which is the amount of your tax decrease under the 2-year rule. Okay. Uncommon RSED tolling. These are pretty unusual. And again, you have the presidentially declared disaster area and combat zones that are out there. I think what it says is if somebody in the combat zone misses their RSED, they do get some extension time later on to file for it, but there's a different process for it. So those of you in a military town may want to look at that yourself. So now we're going into the collection statute expiration date, which I originally thought was the most complicated calculation until we did the RSED calculations, which really shouldn't be that hard. It's just the IRS making it difficult, okay? Or probably better aptly described, the Congress that passed this crazy law, then the IRS interpreted it to the IRM. Somewhere along the way, they really made it tough. So the CSED defines how long the IRS has to collect tax for a specific assessment. The CSED is calculated as 10 years after the assessment date. Each assessment carries its own CSED. The CSED can be extended by tolling events. And for those of you kind of new to collections work, or just going to your first boot camp, or maybe you've been to boot camp, without a doubt, one of the top 1 or 2 data points that you need when you first talk to a client is you need to figure out how much they owe, if they're compliant is a big one, but then when does all this debt fall off? The CSED defines your strategy for resolution in probably over 90% of the cases. Somebody stop me if I'm wrong. Of course, nobody else can talk right now except me and Mitch. So it, in essence, defines if your collection statute date is in 3 months, delay, try to not get a levy. Okay. If it's in 9 years and 6 months, now you're going to have to look and do some real work. Just be advised of that. This defines your entire strategy for a case before you do almost anything else. Okay. CSED section, substitute for return. And this is where it talks about, at the bottom here, the highlighted section, the assessment date will start the period for the statute of limitations for collection per IRC, Internal Revenue Code. Not even IRM, the precursor, the overriding authority, but does not start the period of limitations for assessment. So right there, for those of you that still tell me that an SFR will not start a CSED date, I've showed you 2 different sites. On top of it, I think I have a transcript that actually shows it being written off where it's only an SFR. So here's another troubling issue out there. 40% of IRS CSEDs with tolling are inaccurate. That doesn't mean 40% of CSEDs are incorrect, okay? 40% with at least one tolling event. So if somebody's never really owed money to the IRS, never filed bankruptcy, OIC pending installment agreement, their CSED is going to be accurate because the IRS computer didn't have to do any math. It's when you get any of those tolling events that the IRS has trouble. And again, remember, the IRS computer systems, the core systems in some cases date back to the 50s, 60s, and 70s. Not only that, but some of them are 50s, some of them are 60s, and some of them are 70s, and they have to work together. Okay. According to TIGTA, this is an IRS TIGTA report, recalculations of the collection statute expiration date were not always accurate from September 16th to 2013. I honestly think more than 40% are incorrect. They just looked at a narrow scope involving bankruptcy and found that, out of 75 modules of 75 people, that is not that many. They didn't look at the other things that I've identified as inaccuracies. Okay. These are not the all-inclusive list, but think of it as your most common tolling events. You have offer and compromises, installment agreement, installment and or manual billing extends the CSED. That doesn't mean an installment agreement by itself extends it. It's these rare 488s that are out there. Okay. Military deferment, tax court or IRS instituted litigation, bankruptcy, collection due process, waiver extension of date collection statute expiration date. So they can actually waive it if they so choose. Back in the day, the IRS used to do 25 years left and right. The taxpayer advocate a few years ago did a report, and I think there's like 2,100 people that still showed up in the system as having these CSEDs that were expanded out 25 years. The IRS no longer does it except in extreme rare situations. And that's where they can, I think it's called converting an assessment to a judgment, because a judgment no longer has a CSED. Right? I think it does at 25 years, but it really takes it out. What I thought was confusing about the taxpayer advocate thing, it said all these people's CSED should be wiped out if they're still open. Kind of it was an IRS policy back in the day, and although they were allowed to do it, they really shouldn't have. They were going to little old ladies and saying, hey, sign this, and they were, and extending their CSED way out past when they should. And it goes back to the 70s and 80s when that policy was in effect. But there's people still being affected in it before they got it turned off. What I find ironic about the IRS is they had the list of all 2,100 people, and if I call the IRS and I'm one of those people that had that, they'll take it off. But they won't reach out and say, hey, we've taken the action on your behalf. So I always thought that was unusual. Pending installment agreements. That's the biggest tolling event that screws everything up for any analysis. Terminated installment agreement and innocent spouse. Okay. There's the 550 manually adjusted tolling events. These are hard to see on a transcript. The good news is the IRS does them for us. So you have the Form 900, assets in custody of the court, bankruptcy, judgment, taxpayer assistance order, military deferment again, OIC, except with the incorrect CSED computation, wrongful seizures, taxpayers living outside the U.S. That's a big one because they do have access to the State Department computers to see how long somebody's been outside the U.S., innocent spouse, and other collection due process. Form 911 TAO exception. So this is an unusual one, okay? Let me see here. It's part number 2 of this, so let's drop down to 2. Due to systematic programming limitations, the commissioner decided in October 2003 the Taxpayer Advocate Service does not have to input the appropriate IDRS codes to reflect the suspension of statute of limitations under IRC. The program limitations are still in effect. Therefore, IDRS codes are not input to show the correct suspension periods for IRC 7811 at this time. So I told LG that I ran into this, and I had not seen, in all the transcripts I'd seen, one instance of where a Form 911 had shown up on the transcript and extended the CSED. LG was going to use that as a strategy in a case he worked and called me up and said, didn't work. Sharp revenue officer manually entered it on behalf of the taxpayer advocate and extended the CSED. Okay. And what that comes into is it says in the second line down from 2, the Taxpayer Advocate Service does not have to input the appropriate codes. Okay? They don't have to. It doesn't prevent somebody from doing it. Okay? Revenue officer, examiner, anybody along those lines. So just keep that in mind. It may be a strategy, but if you have a sharp RO, he's going to pick up on it. Okay? Um, and in LG's case, it didn't work. And of course, I've looked, and LG said, we looked at this, and he said, you're right. It says they won't. If you're going to argue this, well, let me finish the definition, and I'll explain how to kind of contest this a little bit. Again, it does not have to input the appropriate IDRS codes. This means the IRS does not have to enter the Form 911 tolling event, but they still can. If the IRS enters the tolling event for the 911, you would like to appeal, the best avenue is with the taxpayer advocate. It is rare that this tolling event is applied, so your position should be claimed under the Taxpayer Bill of Rights number 10. The right to a fair and just tax system. Why is my client singled out? Find some other cases, say in your past experience, there's no other examples of this. Yeah, you can even go out and say, show me some other cases without getting specific. How often does this get done? In LG's case, his client was one out of how many people go to taxpayer advocate and don't get told? That revenue officer singled them out and did it. So you do have a defense. Not saying you're going to win it, but it is a defense. So equivalency hearing is a tool. Okay. Although the IRS tolls for a CDP hearing, if the 30 days after notice expires, the taxpayer still has a year or a year and 5 days if it is a lien notice to file for an equivalency hearing. The equivalency hearing does not toll. For the most part, the IRS does treat the equivalency hearing like the CDP and does not take collection action, but they are not prevented. I do not have any reports of the IRS taking collection action during an equivalency hearing, but they can. So just keep that in mind, okay? Good strategy, but you got to be careful. You can't do it frivolously, so make sure you have at least a reason to do it, and don't ever say I just did it to extend the CSED. That's a Circular 230 issue at that point. Okay. I did have somebody call me recently that said they filed 33 days after the date on the letter, and they were assigned a CDP. Well, they had to go call it the CDP hearing and go kill it. I never wanted a CDP. I was only filing for equivalency hearing. So now the question came up, how do you appeal that they qualified it as a CDP when technically they didn't? They ended up manually adjusting it. And I think what they did is they made him kill out the CDP and said it was input incorrectly. And then he just refiled the equivalency hearing now a couple months after the deadline, and it went through appropriately. But it's kind of funny, don't send it the day after the CDP expires. Give it a week or so. Currently not collectible, CNC does not toll the CSED. Okay. Having your client placed in currently not collectible is a great strategy for reaching the CSED without active collections taking place. The IRS is not barred from collections, so the CSED does not toll, but they do not force collections during this period. Okay. They can, but they don't. The IRS usually requires the taxpayer to reconfirm their CNC status every 2 years. May not be the best solution if CSED is greater than 2 years and you know that they're really going to be able to afford it. It can also be a temporary delaying action while you prepare an OIC or a partial pay installment agreement or something else. Okay, this is the one I've been mentioning earlier. It will be a big part of the next presentation that we're going to do in June. Pending IAs that are not accepted or rejected do not toll. So I started to see this when I first started looking through the million transcripts that the original code was written on 7, 8, 9 years ago now. The IRS was notorious for just listing pending installment agreements and then never putting an end on them. Well, a pending installment agreement is a 971 code, which is miscellaneous. And by that, if the IRS inputs an OIC as pending transaction code on the account, the IRS collections gets all these warnings that they try to do a collection activity and they can't override it. Okay. Problem is with a pending installment agreement and it being a 971, it doesn't prevent the action from taking place. And this is how the scenario takes place. Let's say your client's on the phone with collections or practitioner hotline and it says, I'm thinking about an installment agreement, but I'm really not sure. And that person decides to go ahead and put pending installment agreement into the computer. It doesn't meet the requirements, which we'll talk about later on, but that collections person may not ever go back. It may be ACS. There may not be anybody following up on the case, so it's just kind of like a hanging pending installment agreement. So in those cases, it's not treated as a tolling event until an end is put on it. Okay, an accepted installment agreement or a rejected installment agreement, and I'll talk about that in just a minute. But I have seen CSEDs expire with 3 or 4 pending IAs open on them, and nothing ever happened with them. So it's kind of an odd exception one, and IRS struggles with it, but they also use it to their advantage. If you ever have a pending installment agreement, and this has kind of been the latest, greatest thing. This is what the new presentation is going to be based on, is this one thing. It started about 2 years ago. A CPA called me and said that a revenue officer that had just been assigned to the case had closed out a pending installment agreement from 4 years previously. And it had extended the CSED over 4 years. Well, the CSED would have been up within 12 months when the CPA got the case. And of course, our software read it out to where it should already be expired or about to expire. The problem is the day after the pending installment agreement was filed, they dropped a notice of intent to levy, took collection actions during this 4-year tolling event. For about 2 years, they levied the taxpayer. So in his case, he went ahead and filed a doubt to liability, an OIC doubt to liability, and went at it and said, look, I think the CSED has expired, but let me also say, we might want that money back because you had no right to do collection activity while there was a tolling event. The whole purpose of you extending it is having the tolling event. That RO has done has now become what I think standard operating procedure at the IRS, even though it's not the IRM. It's become a cheap workaround for the ROs and examiners to close these pending installment agreements that were out there forever and do that. The other position you can take, now in that case, what the CPA also asked was this. He said, look, why don't you keep the $2,000 that you guys got off levy? Let's consider the pending installment agreement not being a tolling event and let everything drop off, or it had just gone past that month. And that's what the IRS agreed to. Because the other option was they were going to have to credit the account because they never followed the procedures and it was still within the rules, the 2-year rule. They would have had to pay it back and start from scratch. But then they still would have had 4 years for the extended installment agreement. So I've had people recently start FOIAing the pending installment agreement, and they're FOIAing the explain to me why this is a pending installment agreement. So any paperwork you have on the pending installment agreement. In that example I gave you on the collection person, you just can't put pending installment agreement in just because you guys talked about an installment agreement with the IRS. There's 4 distinct things that meet the criteria. The first one is provide information sufficient to identify the taxpayer, right? If it's on the transcript, they already know the name and the TIN, so that one's already a given, okay? The next one is identify the tax liability to be covered by the agreement. In the proposed installment agreement made by the taxpayer or the representative, you basically have to say the tax liability is $153,000. Now you might be off a little bit due to accruals, but you have to at least have an understanding of very near the exact amount that's owed. So if I say, call the IRS and say, hey, I'd like to do an installment agreement for $100 a month. And the IRS says, no, you owe $500,000. Nope, never mind. When I made the offer for $100, I didn't know what the liability was. That does not meet the requirements for an installment agreement. And if they didn't document it in the system, they need to overturn the pending installment agreement. Okay, so you have to know the amount. Okay, so if you ever fill out a written installment agreement request, that meets all 4 requirements. So if it's in writing, yeah, you're done. I mean, you can hope the IRS lost it. The FOIA shows that they lost it, but for the most part, you're done. Propose a monthly or other periodic payment. You can't say, well, would you take $500, maybe $600? I don't know that that's a specific amount. It's, look, I'm proposing $600. Is that acceptable? I know I owe $142,000 and I'd like to pay $600 a month. Okay. Now you're starting to meet the requirements, but did the IRS document it? And the next one is be in compliance. I had somebody beat a pending installment agreement because when they filed the pending installment agreement, they were not in compliance. They hadn't filed the prior year tax return. The IRS is technically not supposed to do a pending installment agreement if your client isn't compliant at the time of the pending installment agreement. So there's some research for you to do as well. And I have had people recently go down this path and appeal pending installment agreements. Okay. Without going into the entire next class, your best avenue is going to be taxpayer advocate. Okay, and then there's a list that we'll go over here in a little bit. I'm not going to go through these examples on the pending installment agreement. Just know that if you get one of these ROs that does this, go through these examples and try to match them up with what your client has. And let me check the time here. Yep, we've got 3 more minutes. Go ahead, Mitch.
Well, I was just going to do the fifth polling question.
Okay.
So I'll give you guys 1 minute to answer that, and then we can finish up.
Yeah, and I think we're only at 5 or 6 slides left. I kind of went ahead. I wasn't going to go over those examples specifically. I think everybody's kind of burnt out at the end of the 2 hours. It's one of those that if you get that case, look at those specifically, and they give examples of the IRS sent a letter to my client, and the client said, I'm not going to do the pending installment agreement. They never signed it, so that didn't qualify. It's very specific examples that may meet your client. I put it there for position support.
Yeah. It's funny because, sometimes people seem to make it seem like tax resolution's like super easy and then you're just filling out forms and cashing $5,000 checks. But no, there's definitely some tricks to it. And things like statute of limitations are definitely something that you earn your fees on.
Nope, not tricks. We use the word best practices.
Best practices.
Best practices. Tricks sound tricky. So we use best practices, industry accepted best practices. So and let me know when the question's done, and I'll.
All right, we're good to go.
All right. So great job, everybody. I can't believe we pretty much got through on time. How to confirm a pending IA met criteria. Complete a FOIA request for the pending IA in question. Ask for all documentation in regards to the pending IA to include all notes in the IRS system, as well as any written documentation or form submitted by the taxpayer. Most times, you're going to get back, we can't find anything. Okay? It's very similar to where if you're trying to reconstruct income that's older than 10 years, you basically FOIA IRS income records older than 10 years. They send you back the standard form letter saying, we don't keep those in our system. Well, when you go to appeal a really old, late filed return that you're not filing and the IRS doesn't give you credit for the income you're reporting, that's proof that, why are you turning down my reconstruction of the income? You don't have anything in your system. So you obviously either have something in your system that didn't meet my FOIA request, or you're just doing it without any factual basis. Okay. So I feel like even if the FOIA comes back as there's nothing here, because if they deny you an appeals and say, no, we're denying your case because X, Y, or Z, be like, well, I FOIA'd, you didn't send me any of that stuff. So they get in trouble if they don't send you stuff on a FOIA. So it opens up. I mean, they monetarily have to compensate you, if I understand correctly, if they violate the FOIA laws. So the second paragraph in this, if the pending IA was initiated by examinations, they are required to send a Form 3177 Notice of Action for entry on master file to collections. Apparently, and some of you, I know looking at the names are probably former ROs and examiners. I may be misspeaking here, but according to what is in the IRM, apparently exams is unable to input transaction codes necessary to do an installment agreement. So if exams does the installment agreement, they have to fax this 3177. So you may want to put that on your FOIA request, because if there is a 3177, it has all the questions from the previous screen answered and saying that the client, it's basically a note saying, hey, the client answered all these questions. Okay. So in other words, if you get the FOIA and they send you back a 3177 and it answers all 4 of those questions, yeah, you're going to lose on appeal, almost guaranteedly. Unless the pending installment agreement is still 4 years long. Now I'm going to go in and argue what's reasonable time for them to do it. And you can defeat them on that. That's what the next presentation will cover. There are a lot of cases being solved by what that next presentation is going to cover. And I'm excited that LG is going to be able to cover some of it with me. Verify from the FOIA information that the IRS documented the requirements as specified in IRM 5.14.1.3, specifically the proposed payment amount and that the taxpayer was compliant at the time of the request for IA. If the requirements are not met, try to get practitioner line to assist. A practitioner can also file an OIC doubt to liability after the modified CSED passes. Okay, so just some tips there. This is kind of, I've taught you everything over the past hour and 45 minutes. This is how to start applying it. And here's the specific example. IRS personnel abusing pending IAs. I participated in a case recently where a revenue officer denied a pending IA that was on the transcript for 4 years. I gave you this one earlier during the example. I'm not going to cover it again. I'm going to go ahead and move on. But we have seen an increase in ROs and examiners that are extending installment agreements. So how do you calculate CSED tolling events? ASED and RSED tolling events are extensions of time. A CSED tolling event have start and end dates followed by additional tolling days to account for denial of appeals. So for ASED and RSED, it's basically, hey, we're extending it 6 months. So for a tolling event, it basically starts on this date, ends on this date, plus additional days, so it actually extends it out from the time of the tolling as opposed to extending it for a fixed number of time. Example, if an offer in compromise is submitted on January 1st, 2012 and rejected on June 1st, 2012, the tolling event tolls the CSED for 152 days plus another 30 days for the appeal for a total of 182 days. Okay. If 2 or more tolling events overlap, the days in the overlap are only tolled one time. Okay. And here's an example. I tried to do a visual on this one to help explain it. So if you look, the CDP, the bankruptcy, and the pending IA all overlap. So what it does is it shows the duration of the event, but the days tolled. So if we look down at the bankruptcy, okay, the start date for the bankruptcy is actually July 1st, 2006. The duration is 609 days, okay, and I have 2 columns for duration of days for some reason, but it only tolled for 394 days because you don't start the tolling days until the previous event ends. So the bankruptcy doesn't start tolling until February 1st, 07, when the CDP is over, even though it started earlier than that. All right. And if you call me up and say, hey, a CDP should have dropped if a bankruptcy was filed, I understand that certain things may not. This is just a visualization. These tolling events could be anything. So try not to get lost in the, looking at the tree through the forest. So the CDP tolls from the start date until the end date. The bankruptcy only tolls from the end of the CDP until the date it ends. The pending IA does not toll because it overlaps completely with the previous events. Okay. Challenge calculating CSEDs from account transcripts. Tax court, bankruptcy, and CDP all are indicated on the transcript with transaction 520, bankruptcy, or other legal action filed. CDP will also have the 971 collection due process request received timely. It is usually impossible to distinguish between a bankruptcy tax court from the transcript alone. Occasionally, a bankruptcy payment will be listed, but only occasionally. Pending IAs are extremely challenging to determine accurate tolling. The IRS does not have a transaction code for rejected installment agreement. Correction to this, I believe they now have a rejected code, but I'm still working through if it's correct. Okay, so I found some things on the transcript. So I think this was the last logic point that I didn't have that wasn't on the account transcript, but I think the IRS has started putting the closing codes on it. If this seminar has really wore you out and confused you and you really don't want to calculate this stuff, remember, tax home software, we calculate all 3. And if it's a case that's coming up for expiration, we'll do a case consultation at no charge for users of the software. Okay. So I've reviewed multiple Mod A's and have had trouble finding the rejected date on the Mod A as well. It's probably going to be impossible to get Mod A's going forward, even with a FOIA, because of the new faxing rule, but I still refer to Mod A's in the presentation until we know for sure. Oftentimes, the IRS's pending IAs should never have been applied because they do not meet the rules. And I would guess probably 75% of pending IAs that are in the system should never have been put there. Okay. Common avenues to appeal a CSED. And I think this is the last slide before the bonus material. Call the practitioner line and bring it to their attention. File a 911 for the taxpayer advocate's assistant. File an OIC, doubt to liability, but only after your CSED is passed. You may want to do the same with the 911 as well. You're going to get any money back if they readjust the CSED to an earlier date with interest. So even if, if the IRS is levying, then by all means, do some of this stuff. But if they're not levying yet, let the CSED expire and then appeal it. Because you're tipping your hat if you call the IRS ahead of time. And finally, file an OIC doubt to liability, but only after your CSED is passed. The reason is, if I file an OIC doubt to liability a month before the CSED passes, I've just extended it. The CSED's no longer going to be there. Somebody at the IRS could get ticked off that you filed an OIC down to liability and actually have a levy ready to go when you come out of the denied OIC down to liability if you don't get it.
Mm-hmm. Yeah. Yeah, Larry does. We charge in basically two phases. The first part is the investigation, so that and when we do the initial interview, we go over, this. Once we find out, what's wrong, then an offer might cost this much, an installment agreement might cost this much. So you give them an idea, but yeah, the initial container or retainer is only for the investigation phase. Mm-hmm.